In the stock market, there are various terms and strategies used by investors and traders. Let me explain them simply, along with other related terms. First, hold. What is hold? When an investor says they are going to hold a stock, it means they are keeping their investment in the stock and not selling it. They believe that the stock will grow in value over time or that the price will go up in the future. When do you hold a stock? You would hold a stock if you think that even if the price is not rising now, it will rise in the future, so it's best to wait rather than sell right away. Example: let's say you bought XYZ Ltd shares for 500 rupees and the price has dropped to 400 rupees. If you believe the company is still strong and will recover, you may hold on to your shares, hoping the price will go back up. Second, put option. What is a put option? A put option is a financial contract that gives you the right, but not the obligation, to sell a stock at a specific price, called the strike price, within a certain time period. People typically buy put options when they expect the stock's price to fall. How does it work? If you think a stock's price will go down, you can buy a put option. This allows you to sell the stock at a higher price, the strike price, even if the market price is lower. Example: you buy a put option for company A at 300 rupees with a strike price of 250 rupees. If company A's stock price falls to 200 rupees, you can still sell it for 250 rupees, the strike price, making a profit. If the stock price stays above 250 rupees, your put option will expire without profit, but you only lose the money you paid to buy the option. 3. Call option, for comparison. A call option is the opposite of a put option. It gives you the right, but not the obligation, to buy a stock at a certain price, called the strike price. If you expect a stock price to rise, you would buy a call option. Example: you buy a call option for company B at 1,000 rupees with a strike price of 1,100 rupees. If company B's stock price rises to 1,200 rupees, you can buy it at 1,100 rupees, making a profit by selling at the market price of 1,200 rupees. If the stock price doesn't rise above 1,100 rupees, you lose the money you paid for the option. 4. Sell. What is sell? Selling means you are getting rid of the shares you own. This can be done for various reasons, such as realizing profits when the price has gone up or cutting losses if the price has gone down. Example: you bought 100 shares of ABC Ltd at 200 rupees each. When the price rises to 300 rupees, you may choose to sell and make a 100 rupee profit per share. 5. Buy. What is buy? Buying means you are purchasing shares of a company with the expectation that the share price will increase in the future, allowing you to sell them at a profit later. Example: you buy 10 shares of XYZ Ltd at 500 rupees per share, and later, the stock price rises to 600 rupees. You sell them at 600 rupees to make a profit. 6. Stop loss and take profit. Stop loss. A stop loss is an order placed to automatically sell a stock if its price falls to a certain level, limiting potential losses. Example: if you buy a stock at 1,000 rupees, you might set a stop loss at 900 rupees. If the stock falls to 900 rupees, the stop loss automatically sells it, limiting your loss. Take profit. A take profit is an order placed to sell a stock when it reaches a certain price, locking in profits. Example: if you buy a stock at 500 rupees and set a take profit at 600 rupees, the stock will automatically sell once it reaches 600 rupees, securing your profit. Summary of terms. 1. Hold. Keep your stock and wait for its price to rise. 2. Put option. Gives you the right to sell a stock at a specific price if you expect it to fall. 3. Call option. Gives you the right to buy a stock at a specific price if you expect it to rise. Sell. Get rid of your stocks when you think the price won't rise further or you want to secure profits. 5. Buy. Purchase stocks when you expect the price to rise in the future. 6th, stop loss. A method to limit losses by automatically selling if the stock price falls to a set point. 7. Take profit. A method to lock in profits by selling automatically once the stock reaches a set price. Example. Scenario. You own company X shares, bought at 200 rupees each. The price rises to 300 rupees. You can 1. Hold if you think the price will go even higher. 2. Sell if you think 300 rupees is a good price to take profits. Set a stop loss at 250 rupees to prevent a loss if the price drops below that level.